Good morning, everybody. My name is Dave Finale, and this is Real Estate Talk TGIF. This is episode, as you can see on the screen, 343. That's a lot of episodes, but the most thing I'm proud of is the 339 weeks in a row. We have not missed a week in 339 weeks. We did miss one and one only Friday, but we are here on December 27th, 2024. The holiday seasons, Christmas, Hanukkah, all kinds of stuff season. And I'm honored to have an associate of mine, a colleague of mine, a friend of mine, George Tsemberlis, who works with, you do a lot of stuff with investors and real estate and stuff.
Yeah.
Thanks so much for being on. And you're actually not in New Jersey right now, are you?
No, I'm in Southern California right now, San Diego County. So
it's a little early for the people out there. I know they tend to sleep late there. My brother lives north of where you're at. But,
this is true. I'm in a house right now. My family's sleeping as we speak. So, and they have work. Some of them have work today when they're sleeping.
Oh, wow. Okay. So really cool. So
yeah.
Without any further ado, hit it, Nelson. Real estate agents want to acquire clients consistently to grow their business and income for that great lifestyle. This broadcast brings you the best people in the industry to support that quest. This is Dave Finale, and I'm here to bring you the Real Estate Skill Builder broadcast, Real Estate Talk TGIF, brought to you by Real Estate Skill Builder and Align, your premier real estate solution. Yes. Here we are. My name is Dave Finale. Again, this is Real Estate Talk TGIF. And this broadcast is brought to you by my coaching company, Real Estate Skill Builder, as well as the complete place for real estate solutions called Align. It is a great day here, and I've got a great guy on this broadcast. George, you and I actually met doing a deal together, which is where we're gonna actually talk about how we did that deal a little bit. But you've been a loan officer with CrossCountry Mortgage. You specialize basically in builder investor financing along with residential. And, you tell your solutions to meet your clients' needs, which is really cool. But you have partnered with equity firms and different things to have a full and comprehensive amount of stuff to work with. And look, man, this is a great opportunity for people to learn about different ways of investing, which to me, as we discovered in our process together, are really an old way of financing. It has been around forever. I know this because I did it a long time ago. And what's really funny, George, is it took me the whole process to realize what the hell I was doing,
Yeah. Well, it's funny. I think after we closed,
yeah,
it's like a light bulb went off, right? You're like, oh, wait a minute.
It's just to give you a little context to that is we did a DSCR loan, and I had worked on this back in the 80s when I was really heavily into the business and acquisitions and stuff with my family company, which I worked for 25 years. And, we did great stuff in the 80s and 90s, just using ideas like this and different things. And we call things differently. But now, just really cool ways for someone to get their feet wet with this. There's a lot of different ways to do it. But this is one of the ways, which we'll get to. But first, there's two questions. The first question is probably the most important question I will ask you the entire broadcast, and that is, what does TGIF stand for?
TGIF, thank God it's Friday.
You're very close. Just understand 90% of the people do get it wrong, and you did too. It is thank God it's finale. There's no question.
There you go.
This, right? My broadcast, my show, wasn't planned that way. It just happened to work that way. Anyway, here we are. So with that out of the way, George, tell me your story. Tell me, how you got into this, because a lot of people start different ways. And, we evolve as human beings. We evolve as whether we're realtors or financial people or both, or whether we're contractors or developers, but we evolve to it. We don't get there to a place of comfortability. And personally, I don't think I've ever been comfortable where I was. And now I keep moving forward. Hence, we have 343 episodes. Tell me about your story, man.
Yeah. No, I appreciate the opportunity to be on this show. So I went to, I'm born and raised in New Jersey. I went to Montclair State for exercise science, early 2000s. Graduated from there, but then really wasn't excited to get into the fitness industry. I took a job as a personal trainer at a large gym at the time, like a boutique high-end gym in Verona, New Jersey. But then I just saw people around me who were making the ridiculous amounts of money in the mortgage industry at the time. Dave, you probably remember, right? You remember that era.
Oh, yeah.
It was kind of like the Wild West.
Yep.
And so I got pulled into the business. There was no requirements to get any type of licensing. I worked in the industry probably from like about 2004 to 2008 when the market crashed. At that point, if you were working for a major bank, you were not originating loans. There was just too much, obviously, transitions in regards to coming out with new rules and guidelines, especially for the direct lending space and the mortgage lending space. And so if you didn't already have a position at a bank, you basically were out of a job. So at that point, got back into the fitness industry. I also got my real estate license. Still this day, I have a real estate license, kind of like almost we can call it either a dual career. I just kind of like to hold it just to kind of understand what's going on in the market.
Yeah.
Myself personally, I'm not an active realtor myself. I like to pivot and refer stuff out to my realtor partners. But so basically, it was in the fitness industry. Then from about 2008, opened up a gym, a private boutique personal training studio in Northern New Jersey in 2012. Had that for about 5 or 6 years. Sold out right before the pandemic, which is great timing because, as we all know, fitness industry was one of the industries that got crushed during the pandemic. It was not a necessity, right? So a lot of them were had to shutter their doors. And at that time, a good friend of mine had pulled me back into the business. He was like, you got to get your license, got to do your CEs, take your credits. I did that right around 2018, 2019 when I sold my gym, which was perfect timing because fitness completely died. And then I just hit the ground running. I was with CrossCountry Mortgage at the time and just got into the refinance market. But the problem is that, as you're aware, there was no networking going on, right? Especially in the beginning of the pandemic. So it was very hard for somebody. I could tap into my fitness network, my sphere for refinances, which was fantastic. I crushed it my first year, actually my first couple years, especially in 2020, 2021, but I was lopsided, right? So I was kind of yearning to find out how to build relationships, even though things were still kind of like reserved. People were not going to networking events in person. There was some stuff on Zoom. And then basically bounced around to a couple mortgage companies looking for that opportunity to learn how to build my referral partners and my network. Ended up moving to Westchester, New York and rejoining CrossCountry Mortgage on the residential side. Over the last year or two, as we've noticed, the market shifted, right? We don't, as mortgage lenders, we don't have refinances as 50% or 60% of our business anymore. The majority of our business, probably north of 80%, maybe even 90%, is all purchase business right now. And so I'm seeing everybody kind of fighting for the same individuals in the residential space. So over the last year and a half, I opened up my own LLC, and separate from on the residential side, I've partnered with private equity lenders and really got myself very, very well versed and comfortable in the investor space, right? So ground up construction, fix and flip, rehab, debt service, DSCR loans, commercial loans, etc. Just to diversify myself and kind of pivot in working with a different clientele. Love working with the residential space and working with residential first-time home buyers, people who are downsizing. But I'm also looking at different ways to scale my business. And I was just kind of like, what would allow me to have more reoccurring business, right? And so when you work with an investor, right, and this is something that also realtors should be listening to as well. When you work with investors, they could potentially be doing north of 10 transactions a year, right? I mean, I'm actively working with a couple guys right now who are probably doing 10 to 20 fix and flip rehab or ground up construction projects a year, right? And once that gets going, right, once that snowballs, if you're a realtor working with that individual, you now could potentially have 20 plus listings. If you become their go-to listing agent, you can have at least from that one investor, right? And this is in all different markets. I mean, my main focus right now is in Northern New Jersey and then lower New York State. But the great thing about lending is that I can lend in all 50 states. Right. So give you a perfect example. So I was walking my dog yesterday here in northern San Diego County. I saw 3 properties that looked like they were all redone by the same builder. So literally texted myself. I took down the information of the property address, came back to my family's house, jumped on my laptop. I reverse searched that property. I found out who the LLC who originally bought the property before they sold it to the current resident living there. And now I found their contact information through some different business like websites to basically kind of reverse search their LLC. Right?
I'm going to interrupt you for a second, George. I want everybody that watches this or will watch this to understand what you just did, what you just said, right? Mm-hmm. You found something in common for 3 properties, the same developer. I mean, that's not hard to see. You can see different, different. I mean, it might be a color. It might be something that they do. But no matter what, even if it was 3 different properties, you came back, your mind has always been working, even though you're out west, it's probably more relaxing for you there. Your mind hasn't stopped, right? And you keep going, and you always thought, and that was one thing my dad always told me. He says, whenever you go home, never go home the same way. Always be looking for stuff. I mean, it's not something you're going to obviously be looking for, but you didn't go out to take your dog for a walk just to see that. So I'm sorry to interrupt you, but it's really important for people to see that little thing that you did. Mm-hmm.
Yeah. It's just kind of having awareness and knowing kind of where I'm kind of pivoting in my business and looking at, I'm brainstorming at different ways of how do I get in front of investors, right? I can go to those investor conferences coming up in the new year. I can try and look at properties that are basically what I do sometimes is just look up LLC owned properties, right? So you look at absentee owners, you look at properties that were bought in the last 12 months by LLCs, kind of doing the same thing that I just did, reverse searching, and then getting that contact information, getting the email, getting the phone number. And when you can offer some type of value to that person, to me, it's a lot easier conversation than cold calling. I understand what realtors go through when they're just cold calling people for potential residential listings. Whereas on the investor side, it's completely different conversation. It's really more B2B, right? At the end of the day, when you talk to somebody in the residential space, it's emotional for them. They're probably getting inundated and bombarded by a lot of different realtors looking to list their property, especially in this current market, because especially in the Northeast, we have an inventory shortage still. And so this is a great opportunity for those of you in the real estate space and also the mortgage space to kind of pivot and really scale your business and kind of go a different direction for 2025.
Okay. So I want to go back to one thing that you talked about, and you talked about your business at one time was lopsided. When you said lopsided, was it more refi than regular residential mortgages?
It was probably 80% residential refinances, right? It was at that time, I was in the fitness industry for over 10 years. And so I had a good rapport, even clients that weren't members of my gym anymore. When I sold the gym, I still had good relationships with. Even to this day, I have old training clients of my gym who reach out to me for a purchase mortgage, who reach out to me for a line of credit, who reach out to me. So it's going back to just touching your sphere. And so I was probably 80+% residential refinance. To just give you an example, like my first year, I did like 26 million, probably 15 million or maybe even more it was refinance business.
So basically you did 15 out of 26 or more by referral. Mm-hmm. And you call your business here, guys. I want you to listen. The reason I asked the question. You call your business lopsided. Most people would call that fantastic, but I understand what you mean and what you meant, because you reached out to the people you knew. You reached out to a list you had from your previous business. There's a lot of realtors that get into real estate that forget about their previous business. They forget about their previous relationships and say they don't have a lot of people to talk to. The main reason for the question was to make that point, was to say that you've got a lot of people you can talk to. I'll look at my own thing, right? I didn't think I had anybody to talk to until I started thinking, well, I used to know this guy and I used to do this guy. Why don't I just reconnect with them? What the hell? What's the worst that could happen? They tell me to go to hell, right? So that's fine, right? Anyway, so then you talked about the other great thing is is when you talked about who you're going to reach out to and using the investor strategy for a realtor or for a loan officer, loan professional. B2B can be easier, right? It all depends on where your expertise is, though, as a realtor. Would you agree with that?
100%. I think you also have to be comfortable in that space, and you have to be able to have a good conversation with somebody who's experienced, right? So there might be a little bit of a learning curve, but it's like anything else, Dave, right? Like you're going to get rejection, you're going to get shot down, you're going to have, to your point, it's like you're going to cold call and you're going to trip over your words, and but you learn. I learned this investor space because I partnered up with one private lender who we work together in the same office. We basically share a space together in northern New Jersey. So I just sat and listened to him speak to his clients. He's been in the business. He was on Wall Street for probably over 15 years, and now he's in this private lending space. And I would just listen to him have his conversations, and then he and I would just go through some like exercises, just kind of same thing to how you coach your realtors, right? Like going back and forth, going over some scripts, going over some rebuttals, and just got comfortable. And within 6 months, I felt comfortable having conversations and cold calling people and being able to give them some type of value in that when I had that conversation with them.
Was it a decision? Was it a discipline you had to learn? Was it a commitment you had to make, or was it all of those things?
I think it was a combination. Of both of them. I think I was looking for more in the lending space, in the industry. I was getting a lot of opportunities coming on my desk, but I was like, well, I don't know how to do these, right? Like I don't know how to do commercial mortgages. I don't have the outlets for those. I don't understand investor loans, right? And so I was getting frustrated because I felt like I was just leaving business on the table.
Right.
And then also too, I just felt like, I was, a lot of people listening right now, they know CrossCountry Mortgage, right? Like CrossCountry Mortgage is a fantastic company, but what I'm noticing is there's so many of us now in this company. Like we're just overlapping each other, right? We're competing with each other. Never mind all the other mortgage lenders and all the banks that are in the Northeast. And so again, it was just a way for me to kind of create another vertical, right? I'm going to still continue to do residential. I love working in that space, but now it's like, okay, now I have this other space. And for me, it can go both ways, right? Like I can help somebody finance a ground up construction or a rehab, right? And then all of a sudden he puts it on the market with a realtor, and I could potentially do the open house with that realtor and then potentially get the financing now to purchase that property, right? So I look at it like it's just like it's constant, it's more consistent business,
right?
Whereas, give you an example. I have somebody now, I'm doing a refinance for, they bought a house about a year ago, but that's very rare right now. Most people are refinancing. Like if they bought a house in the last 2 years, besides maybe buying a second home, they're not transacting again on the residential side. They might do a home equity line of credit, maybe to tap into some equity,
right?
But they're not refinancing. So, I'll reach out to these people, and you hope that they during the holidays, they're having a conversation and they hear someone say, hey, I'm looking to get pre-approved. I'm going to buy a house. And they're like, oh, call George. But then I know people who are very funny about taking recommendations from family members when it comes to finance, right? So it's hit or miss in that space. Whereas again, kind of going back to what I said before, guys, it's B2B on the investor side, where it's strictly just all about business. And if you can show value to your investor, they're going to come back to you again and again and again, right? And so now all of a sudden you can really scale your business in that arena.
So I want to hit this value thing. Since the whole thing with this lawsuit with the NAR, they talked about buyer agents having to do more and show value. And you said the word value several times. So and one of the things in the context is when you offer value, a conversation can be different. You can have a conversation. When you're talking value, George, what are you talking about?
I mean, there's a lot of ways that I try to show value to my my investors. One of them is just being available, answer questions, showing them the numbers, helping them, giving them some my own opinion in regards to a certain property, if the numbers make sense or not, and kind of going through that exercise with them. Then also too, with my journey of connecting with different private lenders that I broker to, there's some unique products out there that not every lender offers. And so it's a very easy conversation when you can offer something to an investor that they haven't seen before, right? And to give you an example, in the rehab fix and flip space,
Right.
most of the time, somebody, when they do there's the rehab budget, they have to do, they request a draw from the money for the rehab. It's a reimbursement. They have to come out of their pocket, right? And then once they complete that phase or almost complete that phase, they can request to get reimbursed, and then they go into the next phase, right? Well, there's some lenders out there that I work with that offer the opposite. They allow that investor to do advances, right? So instead of coming out of their pocket, they just can draw the money. And then what's also interesting is this same lender that I work with, they allow you to escrow all your interest payments, right? And so for those of you who are getting into the investor space, you're going to learn the one challenge is for investors who are looking to go vertical and do multiple projects at one time is cash flow. So if I can offer of the value proposition to my investors, say, hey guys, you kind of seem to you're getting stuck at like 2 projects at a time. I have a couple products that are going to allow you to do 4 projects at a time. And for them, that's huge, right? Because now they're just coming out of pocket for the down payment and for the closing costs for the acquisition of the property or the land. But then they're basically borrowing the rest of the money for the project, and they don't have to make any interest payments while they're doing this construction. So that's one way that I bring value to my investors, is just coming up with finding different products that they're not aware of to be able to let them scale their business.
So there's the value there. And I want everybody to understand too, that the difference here between bringing value to an investor is different and can be different, not always, but can be different than to a home buyer. And that is knowing ways that they can innovatively or evolutionary build their investment portfolio or to keep going, right? So when we get to investments, George, there's investment strategies and there's investor strategies. And one of the things I've always coached real estate agents to do is that if you come across an investor, ask them what their strategies are first, right? And go from there. Talk to me about how investment strategies can differ from investor strategies and vice versa.
Yeah, I mean, so I noticed with a lot of investors, especially younger investors who just kind of, they have their primary residence, they're looking for other forms of revenue, and so they usually will go the traditional route initially, right? So they'll go back to their traditional mortgage lender and they'll do like a traditional Fannie Mae or Freddie Mac investor loan to buy a property. The negative is with those loans is that they're using your personal income with whatever you do for a living full time. Plus, you're trying to qualify based on how you basically structure your taxes on your Schedule E for your investment properties in regards to how you write off your income on the current investment properties that you own. What I've noticed, there's a point where an investor hits a ceiling. I've seen it where it's like it could be 4 or 5 properties where, because of the write-offs they're taking on their investment properties, they get to a point where they just can't qualify anymore for that next property, right? And so there's products out there where the property qualifies itself. The underwriter is not looking at your personal income. They're not looking at your other investment property income. And this is kind of what we worked on, David, right? Where you what did you call it back in the day? You called it was like a bullet mortgage or something.
We call it, yeah. So an interest only loan typically was called a bullet loan, and a bullet loan this is back in the 80s. Now let's remember that what had happened was that in the end of the 70s into the 80s, interest rates were very high, 18 to 20%. People were still buying houses, by the way. And along came the great Ronald Reagan, who came up with this ACRS thing called the Advanced Cost Recovery System of depreciation. And basically it meant that you could depreciate a commercial property over 15 years straight line, right? Where before there was 35, 30, now it's like 27 and a half, whatever it is, right? And so what happened is that in time, as things started getting really good, they also got worse. So near the mid to late 80s, there was a lot of problems with people that they couldn't qualify for the loan. So what they did was they went through the debt service coverage of a property, and it was an interest-only loan based on what the debt service coverage was. Debt service coverage meaning the income you're making to cover the loan. That we were looking for anywhere from 1.18 to 1.25. as a good loan. The problem was is that it was interest only, and it came due in 3 years, 5 years, whatever, and they called it a bullet loan. Why was it called a bullet loan? Because at that time it was due, you'd put a bullet in your head because you didn't have the money. That was why it was called a bullet loan. Anyway, so thank you for asking that question. Well, that little story.
Anyway. Yeah, and so that's somewhat of a similar product nowadays, but it doesn't have the same outcome where you're going to want to put a bullet in your head. They call them basically like long-term rental loans or DSCR, debt service loans, and it's basically the property just has to cover itself, right? For example, you have a property that the mortgage either be interest only or principal and interest. You have your mortgage payment, you got your property taxes, you got your homeowner's insurance for the property. Let's just say that all in is $5,000 a month. As long as you're able to collect $5,000 a month or more in rent, sometimes you can be a little bit under that $5,000 as well. You can still qualify. The property covers itself,
right?
As long as you got a good personal credit score, and you can show the liquidity to put the down payment and cover closing costs. You have to show like 6 months of mortgage payment reserves as well.
Right.
You'll be able to qualify for that property. And what's great about these products, the true debt service products, they're business loans, they're entity loans. These don't come up on your personal credit, right? So these aren't going to affect you when you go to do other personal loans, right? You want to go and get qualified for a car. You want to buy another property in your own name, a second home, whatever it may be. This actually won't come up on your personal credit report, which is fantastic. That's what's unique about these products.
Yeah, and the great thing is this is the DSCR loan, which we've discussed a little bit, is more or less depends on the phase that you're in or the investment area that you're at. We talked about investment strategies as compared to or versus investor strategies. There's two different things there. So as we talked the other day, it depends on what phase you're in as an investor. Like, one of the things that I think people get this thought about, George, is that they think when we use the term investor, we're talking about this guy that's buying a 100-unit apartment building and he's got eight shopping centers. No, when we talk investor, we're talking about that guy that's buying a two-family, or he's got a couple of two families, or just you're just into the investment where you bought a two-family and your goal is to buy another one on down the line. And there's a lot of different ways to do that. So talk to me about some of the strategies for a small investor, depending on the phase that they're in.
Yeah, I mean, that's great. I think one strategy that people are familiar with is called the BRRRR method. It's like BRRRR. And so say you have a property that needs a lot of work, right? So you can't necessarily use a traditional mortgage or even a long-term investor loan because it wouldn't get the CO. So in that strategy, you would either do a renovation, fix or flip loan or a bridge loan to acquire that property. That at that point, you either use your own capital if you did a bridge loan to renovate that property so you can get a CO, or you use the lender's money in a rehab loan to finance the renovation on that property. And then if the property seems like it's going to cash flow and you don't want to flip it and sell it, you do what they call BRRRR method, which is now you refinance it into a long-term debt loan, like that debt service loan that we just talked about. That's one investment strategy right there, right? That you guys can definitely take advantage of.
Yeah, and so when we talk about what phase of investor you're in, I mean, you can do any of these things that you've heard about or talked about. I mean, there's traditional loans, there's no doc loans, some of them, not many. There's rehab loans, fix and flips, DSCR, a renovation loan, 203Ks, all this other kind of stuff. But it all depends on, knowing, kind of having an idea of what you're doing. And no matter what, George, I'm sure you'll agree with this, is you've got to know the numbers. You've got to really have a strategy. And, when I ask realtors, I called this, for rent by owner guy, and he says he didn't want to use a realtor. I said, and you hung up? They say, yeah. I said, well, why didn't you ask him if he loves being a landlord? Why don't you ask him if he's looking for more investments? Then why don't you ask him what his investment strategies are? Proudly, I one of my two daughters owns two pieces of real estate now. One's a rental property for her. And she did it without even thinking about that's what she was going to do, but it just worked out. And when I told her, you're now an investor, she goes, well, what do you mean? She was like, well, you just drove from West Jersey to Hoboken to check on your property, your condo. Because yeah, he says, all that mileage, that's deductible. The painting you just had done in your apartment, that's an expense. She goes, really? I said, yeah, it's now a business. You're now a business owner. So a lot of people don't see that. I mean, look, this can really work for a lot of people who are in Hoboken now, because let's face it, Hoboken, New Jersey, those who don't know, is, it's more of a, it's people want to live there that are just out of college, typically in their 20s, early 30s. And a lot of times they move out to what they call the burbs after that, because it is city living. And they forget that if they own, they now can rent that out because it's going to rent and for a nice dollar. But you're now an investor. So there's a lot of paths to wealth through investment, right? Yep. Talk to me a little bit about how you work with newer investors and how that can work and how you can help them.
Well, I mean, you brought up a perfect example, and we're going to see this continue right in that condo space in certain markets like Montclair, New Jersey, and Hoboken, New Jersey, yep. Right? And I live in Westchester, and you're seeing it in like White Plains and New Rochelle and those areas, those markets as well, is that people bought these condos to live in 2-3 years ago, 4 years ago, and they have ridiculously low mortgage rates, 2.5%, 3%, 3.5%. And they see that rents have gone up probably 10, 15, 20% in these markets over the last 3 to 5 years, that there is a great opportunity for them to now keep that property. They almost kind of fell into being an investor by accident. Right. Which is great. That's awesome. And that's now you learn. You're learning, okay, you bought your new primary residence. Now you get to write off that interest, right? You get deductions on that interest. You get deductions on depreciation. You have to do, like you said before about your daughter's place, like you got to repaint. You have somebody moving out. You're going to put $10,000 to redo the bathrooms, to redo the kitchen. Like all of those things are tax deductions, right? So that's great. And there's going to be so many more people that are in that space. The negative thing with that is that what happens with those properties, Dave, is that all of a sudden they become non-warrantable, because when you have the utilization in that condo building is now more investor than resident, it makes it more difficult for the next individuals who want to buy as a primary residence in those buildings,
right?
to use traditional mortgage products. So that's the only negative in that situation, is for the individual who want to buy in those buildings and those numbers, because I'm seeing that over the last 12 months where I've had to go with some more non-conventional mortgages on certain condo projects, because you can't go a traditional route with like Fannie Mae, Freddie Mac, or just like a traditional bank loan.
Right. So the thing about that is the new investors just have to look a little bit out for that. But still, I mean, it's an advantage to them. Well, let's talk about the people that bought after the pandemic in cities. They bought condos there. This is, my daughter's exact thing that she did. She bought a condo right after the pandemic, and the inner city was a place that people actually left, right? They left city. They left. I mean, look at the prices. If you look at prices from 2020 to today of what condos did, what rents have done, right? And it's funny, the number one place that people moved out of in New York City was the Chelsea area. Number one place they moved out of. You know what the number one place they moved into that same time? The Chelsea area. Why? Because it got cheaper to live there. Yep. Right? They moved out of it because they needed to get out of the city, but people moved in because this was the time. This was the time to invest there. Yep. And now the rents are sky high again. And it's actually working out for a lot of people. Talk to me a little bit about people want to get in to be fix and flippers, right? Oh, I'm gonna buy something, I'm gonna fix it up and flip. I've seen a lot of people go in that think they're a contractor because they got a hammer and a pickup truck. I used to say that in the 80s, by the way. And they're gonna buy something, they're gonna fix it. They do shit work, and they think they should get all kinds of money. Talk to me about your experience and what you've seen there and what people should be doing if that's the route they want to take.
That's a great point. I've seen it. You've seen it, right? You've seen these kind of horrible fix and flips that was just like lipstick on a pig. They're trying to get top dollar. And then all of a sudden comes time for inspection, and the inspection fails, right? There's some issues and stuff like that. And now you have this back and forth with attorneys. So one thing that I advise somebody who's never done a fix and flip before, and they've only bought a primary residence, and they moved into something that was move-in ready, I would actually tell you, for multiple reasons, to partner with somebody on your first couple projects who has the experience.
That's a great thought. That's a great idea.
Some people are great at learning on their own, but that's not for everybody. And guys, let's be realistic here. You don't want to take all your hard-earned money that you've put away for savings and then all of a sudden blow it away on a real estate venture that you really weren't prepared for. And so also too, just so for the listeners out there, just understand too, is with these loans, lenders aren't going to necessarily lend to somebody who has no experience. If they're going to, the rate's going to be substantially higher than compared to somebody who has experience. When I say experience, they may have done a certain amount of transactions in like 36 months, right? So the way that we circumvent that is that I will advise my really like new investors to partner with could be the contractor, right? Because we as a lender, I can use the contractor's experience, either their own fix and flips that they've done or their own GC work they've done, right? So say they've done a couple $300,000 renovations for a consumer. They've done a couple $500,000 renovations. They've done a couple $100,000 renovations. I can use all that renovation experience to qualify them for better terms and better products. And that's where I say it's important for you in the beginning, because that's where you're going to learn. Just like I said, that's how I learned the business of understanding investor products, is that I partner with somebody who I just listen to, and I shut my mouth and I let him educate me on the process. It's the same thing. If you're not handy and you're not comfortable when it comes to doing renovations on your own, but you want to get into that space, I would definitely recommend partnering with somebody who's already done it, or somebody who's a contractor who has experience in pricing up the jobs and making sure the numbers work.
That's really important, making sure the numbers work and making sure that you have your goal in mind, your strategy. We talked about investment strategies and we talked about investor strategies. I want to talk a little bit about that. Really, your investor strategies is what you, in my opinion, is what you want at the end game. Your investment strategy is, okay, am I going to fix and flip? Am I going to buy something, renovate it, and sell it? Am I just going to put lipstick on a pig? Look, sometimes you can do that. Sometimes you can just go in, paint, change a countertop, put in new appliances. You can do that, and it's going to work out fine, and you're going to do really, really well. Coat of paint can do amazing things if that's all it needs. But be careful, you're not just painting over shit, right? But your strategy has to be what it's going to take you to do it. If you don't have the experience, you're not going to know what things cost, right? So you need to look at it. And the way I look at it is, most of the time when I go into something, even if it's going to be minimal, I'm going to spend between $30,000 and $50,000 on a project, right? That's going to be paint. That's going to be floors. That's going to be cleaning. You can spend that much just on those three items, right?
Yeah.
And it's really important, because the cleaner a place is, the better it is. What are your thoughts on that, the difference in investor, and where you want to go with it, and what you're going to know?
Well, I want to kind of put it out there. I think a great way for you to learn how to be an investor, but also kind of live in the project, is buying a 2-family property. So say you're a first-time home buyer, right? And you sit down with a mortgage lender, and that's what I normally do. My first-time home buyers, I'm like, listen, are you open-minded to a 2-family? I'm like, and they say yes. I'm like, fantastic. Let's look at the numbers, right? You could potentially have 50% or more of that mortgage being paid by the tenant who's going to live in the other unit that you're not going to be residing in, right? That's the one perk. The other perk is you kind of get to live in the investment property and learn, right? So not only do you have at least half the mortgage being paid by your tenant, you're also going to learn the different costs that are going to come up. You know, all of a sudden you're going to have a water heater that's going to go bust. Now you're going to have to get that replaced, right? You're going to have to deal with like snow removal. You're going to have to deal, if you're in the Northeast, landscaping, all these different things that are going to come with not only just owning a property, but owning an investment property, right? Like having a tenant knocking on your door. Like my parents, I grew up in a 2-family. Like some of our tenants would literally knock on our door at 2 a.m. when something went wrong in their apartment, right? So kind of getting used to that and seeing if it's for you. Because if you can't handle that, then maybe owning investment properties and dealing with tenants is not for you. Or you might hire a management company once you build up a big enough portfolio. But I think that's a great way for somebody who's never really experienced owning investment property, is actually living in the project for 12 months. And then using that property now to maybe potentially buy a single family home as your new primary. Or I know some people, that's their strategy, right? They keep buying that next two family, right? Well, they do a 3, a 2, and then a 1. They go 3 family, then go down to a 2 family, which makes sense to an underwriter that you're going from a 3 to a 2, and then using another first mortgage for a primary residence to buy your single family home. But now you built yourself a portfolio, and then you pivot to those investor loans that we talked about earlier in the show. So that's a strategy right there.
Man, you just you just gave the really simple investment 101 strategy to a person that wants to invest. Because here's the thing, to be a landlord is something very different than being a homeowner, right? A landlord basically is, you're going to get those calls in the middle of the night. And I was a landlord for 40 some years. Mm-hmm. And one of the things, the reason I sold my properties, and not that because I got a lot of calls in the middle of the night, I rarely did, because I did this stuff during the day to make sure that shit didn't happen, right? Yeah. I got one lockout, one drunk tenant. Rarely, you're never going to be able to circumvent a broken water heater, because they all will break in the middle of the night. If you want to know why and how you can change that, reach out to me. I'm not going to tell you. I'm not going to tell you the secret. I know why they break in the middle of the night. It's a long story, but it's easy, simple. Anyway, the thing is that if you're living there, you know what's going on. You know what your people are doing, the landscaping, the snow removal. Just like you said, man. I mean, there's a lot of things. But anyway, I stopped. I didn't want to be that person to be called anymore. I did all the snow removal on many, many properties at one time. And look, we used to get lots of snow years ago. Yeah. And, it was one snowstorm out after the other in weeks and stuff. And then you have the problem. Sometimes you have a property where you got no place to put the snow. So these are little things that can happen that you need to experience. And George just gave you the synopsis of what you need to know and how you need to learn. That's just, to me, what you put there was really great. And the other thing to give people an advantage is there's a lot of ways to buy properties, as we've been talking about for the last 35, 40 minutes or so. And don't be afraid not to put a lot down, right? So if you can qualify for the mortgage, whether it's FHA or conventional, whatever it is, look, that is another strategy to use. The old expression that came out in the 80s, and there was Carlton Sheets, OPM, other people's money, right? You always want to try to use and utilize other people's money. You know what we call that? Leverage. You've heard that word a lot. Leveraging your assets is really important. What else might you add to that, George, as we're coming up? What do you got for that?
Yeah, I mean, I think you kind of hit with the word leverage, is that you have these first-time home buyer programs, but they're not just for first-time home buyers, right? So you can use an FHA loan multiple times. You just can't have multiple.
Right.
Here's what that you can, depending on mileage rules, but we'll go into that another time if you reach out to me. I can dive into that down the road. But just to keep it nice and simple, you use an FHA loan to buy a 1 or 2 family property. You now, rates come down. You've been in that property for 12 months. You refinance that property into a conventional loan. You now free up the FHA to buy the next property. And you can do it again, and you can do it again, and you can do it again, and you can potentially do it up to 10 times, right? And it's the same thing with the conventional space as well, right? So you could leverage, take advantage of these products. We're probably the only country in the world that has the type of mortgage system that we have, right? Where we have Fannie Mae's and Freddie Macs who are securitizing and buying the debts, and you got the government who's just pumping liquidity into the markets depending on the cycles that we're in the economy. And we have these great products. We have these 30-year fixed terms. Most countries don't have 30-year fixed terms. We're one of the only countries that offer that long-term debt. In Europe, I think, for instance, it's they do kind of bullet loans. They do 3-5-year loans, right? And all of a sudden, we heard this happen a couple of years ago. Their interest rates soared because their rates adjusted, and they're starting to having a large default crisis in Europe. We don't have that here in the United States, and so you guys just need to take advantage, and that's why you need to speak to a loan officer who understands those those different products that are out there to give you the best strategy for your situation.
Yeah, and that's I mean, Canada the same way. I mean, I think the
Yeah.
mortgages are redone every 7 years or 5 years or something like that. I'm not sure of that.
Yeah, and you take it or leave it, right? Like wherever the rates are based on whatever index it is, that's your new mortgage rate. It could be 7% one cycle, and the next cycle it could be 14%. We don't have that here in the U.S.
Yeah, no, you don't. And look, there's so many advantages. And one of the things I do with Real Estate Talk TGIF is I bring on the greats. I bring on the people that know their shit. And obviously, you've gotten not only Real Estate Investment 101 from George, but you've got 401 as well, right? You went up we went up 4 different levels of what you can do and how you can do it and the easiest way to get started. And, honestly, guys, I mean, if you're watching this, please rewind, watch the whole thing and see it again, because there's a lot of things I don't want you to miss that are really, really important for you to think about when it comes to investing. And when it comes to, more importantly, for your real estate business or your mortgage business, how to help investors, because you'll understand the simple specifics of the business. Hey, man, I want to thank you so much for being on today, for giving out all this knowledge and dropping all these gold nuggets. I really appreciate it. Is there any advice you would give the general realtor about investors and investment?
I think it's just the same advice you would give them, is make sure they're just asking questions, right? It's just like when you're talking to a consumer, it's asking the right questions, peeling back their pain points, building the relationship of how you're gonna help them either find inventory, bring good products to them, connect them with lenders that are going to give them unique products to allow them to scale. It's just going back to the same word we used before, which was value. And it's the same thing with me, right? Like I'm going to say, hey, you know what? I have some great realtors who have off-market pocket listings that would love to work with you, right? And that's the way that I also give value, is like I'm going to connect people, and then what I hope in return is that it's going to come back twofold. So this
is great. Last week we had Jamie Mooring on, who talked about new construction and how he got involved. It's very, very similar to what you did, and just another aspect of the real estate development, the real estate market, real estate life, right? 2 things, man, left. One is a question. The other is something I have for you. The first is a question. How do I help you grow your business?
Well, I mean, I think the most important people that I want to connect with is either builders, contractors, and investors. And so if you know anybody in that space who's looking for maybe some different products that allow them to scale, I think that would be awesome. If I can have an opportunity to just be connected with them, that'd be great. I'm sure we're going to do that in the future, near and far. Man, I want to thank you so much for coming on. And as you know, one of the values that we have in this business, in this broadcast, is everybody gets a hat. Everybody gets a hat. I mean, this is I got to cover this bald. You got to cover that, man. And especially if you're on a golf course. So that's also important. Oh, 100%. Anyway, guys, George, I want to thank you so much for coming on. The hat's coming your way. Look, guys, this is the last broadcast of 2024. We're going to hit January ground running next week. We've got so many of the greats coming on, people that you've heard of, and lots of them. We don't have dates booked exactly yet, but we're going to have, I promise you, the greats and people you may not have met, but also a lot of local realtors, which this program is all about. How to help the young realtor, the new realtor, and how to help any realtor just build their business, as well as loan professional, just to help you build your business. Please reach out to me, to George. You have George's contact information there scrolling on the bottom, as well as his Instagram. Thank you so much for allowing me onto your computer screen, your phone, your iPad, whatever. God bless you all. And George, thanks so much. And just stay on for a minute as we finish. Nelson, thank you. Hit it.